short-term rental loophole. Is it unlimited the amount of short-term rentals you can stack and the losses you incur each to offset your income?
Yes. So that's always our second option. Our first option when it comes to tax planning is looking strategy.
Remember when he said that there's gonna be a trivia?
Yes.
That's the answer, C.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
Let's say you already have a real estate. Let's say that the room or the HVAC is super old. So then therefore, let's say you're waiting until next year when you do buy the roof or the HVAC, maybe you could consider investing in it now so that you could get some of that tax benefit this year instead of next year. So it's about playing with the timing is what I'm talking about. The next one is entity choice. This is very relevant to people like Esmeralda, who is a real estate broker, or my house flipper. A lot of them are LLCs, and also a lot of them just do their business through their personal name. And the problem with that is that when you do that, there's something called self-employment tax, which means whatever is your profit, you need to pay payroll taxes on the entire profit. So let's say if you make $100,000 in profit, I mean that you need to pay 15.3% in taxes for the entire $100,000. Whereas if you become like an S corp, then you pay yourself in W-2, you will only need to pay yourself payroll taxes for the amount that you pay yourself in the W-2, and whatever you pay yourself in distributions is not required to be subject to payroll taxes. So
All of this just applies to me, right? Because you keep saying my name.
we can say here, it's easy to pick on since you're here.
Heck yeah.
All
I'm
right.
glad that you pick on me.
Yeah, we went about the time difference, so we could now move on. So a lot of people don't understand like, the value of tax planning. A lot of people see tax planning as a high price tag. I have personally sold tax plan for $10,000, $20,000, even $30,000 tax plans. And some people see that as not being worth it, but you have to see it as an investment, right? So, for example, do you guys think it's worth the investment if you paid for a $10,000 tax plan, but it's gonna save you $40,000 in taxes? Obviously, the answer is yes. It's all about the return on investment. So another thing when it comes to evaluating a tax plan is that some tax plans require spending and some tax plans do not. For example, some of the tax plans that require a cash outlay is stuff like buying a short-term rental, doing a 1031 exchange, making retirement contributions, and setting up charitable donations. So I would just say that these to some people are less desirable, especially if people don't have the liquidity to do so. So that's always our second option. Our first option when it comes to tax planning is looking for strategies that do not require a cash outlay. For example, doing a step-up in basis. Like for example, when somebody inherits a property, that's when you do or changing the legal entity type of the business to save more money. And also grouping election for your portfolio and the timing of the income and expenses. Those tax strategies do not require cash outlay, so they are more desirable for a larger group of our clients compared to strategies that do require cash outlay. So examples of a high value tax plan. One example is a short-term rental loophole. Out of curiosity, who here has short-term rentals? Who here has Airbnbs? Nobody has Airbnbs yet? Okay, so one of the biggest advantages of owning a short-term rental is that normally you cannot offset your passive losses from your real estate from your active income. When I say active income, that means your W-2 job, that means your business. But if you have short-term rentals, what's cool is that as long as you spend 100 hours on your short-term rentals, you are able to offset your active income as well with your short-term rental losses. So, for example, let's say you make $200,000 from your W-2 job, and then let's say your short-term rental makes $50,000 loss after depreciation. What's cool is that you can offset your $200,000 W-2 income with a $50,000 loss from your short-term rental, so then you're only going to get taxed on $150,000 instead of the full $200,000, which is very cool.
So you have about a 100-hour rule in order to offset the income, so I think it said the short-term rental.
Yes. Yeah. But when it comes to long-term rentals, it's a much harder. Instead of 100 hours, you need 750 hours of real estate hours, and you need to spend 51% of your time towards real estate and 500 hours towards your own personal real estate. So it's a much higher standard than that. When it comes to selling properties, you guys already know a lot of this, 1031 exchanges, property donations, right? So if you donate one of your properties to, you can avoid the capital gain from that charitable donation of the property. Plus, you can get a deduction of the fair market value of the property on the time of the donation.
Remember when he said that there's gonna be a trivia?
Yes.
That's the answer, C. Okay?
Okay.
No, just-
And then lastly, there's also swap dogs. So if you've never heard that, you go ask me after this presentation because we're running out of time. When it comes to more active income, like flipping and wholesaling, something that we can look into is changing your legal entity to help lower your self-employment tax. Paying attention for the special prize, okay? So here's my question. If a real estate investor rent average for 7 days of that first day, and they spend 100 hours per year managing it, what rule allows them to offset their active income with their passive losses? Good job. Please send me, provide me with your contact information. We can do a free tax assessment for you, where we give you 2 free tax tests. There we go. Thank you very much. Does anybody have any questions for me? Yes, ma'am.
So you talked about the S corp and how you can pay yourself a wage and then you can pay one as a profit, right, without paying taxes.
Yeah.
But can you do the same with an LLC that you designate as an S corp?
Yeah. Yes, you can do that. Okay. Any other questions?
The short-term rental loophole. Is it unlimited the amount of short-term rentals you can stack and the losses you incur each to offset your income?
Yeah, so that is a tax strategy on grouping. So, for example, let's say that you have 3 short-term rentals. And let's say that you spend 33.3 hours on each one of those short-term rentals. Normally, if you were just counting it as a per short-term rental, you would not make the 100 hours. But if you group those short-term rentals together, then you would qualify for the 100 hours.
For the short-term rentals, should you have it under an LLC?
So that's a very common question I get is, should you have it in an LLC? And what I always tell people is that there is no tax advantages to having an LLC. Having an LLC just protects you for just legal protection. So there's no tax advantages to having an LLC. Thank you very much.
Well, thank you for giving them Take a moment.
Gather the papers, receipts in a row, punch in the numbers, watch the totals grow. Deductions here, refunds there. You're a tax wizard beyond compare.